Under the Hood with Dimitri and Mustafa.
If you are interested in timing the markets, okay,
Hmm.
these are the types of things you've got to hone in on. And what's happening right now, and what the most recent data has showed us or reflects in terms of unemployment, is so super important in determining where we are, in this 9 innings, right? This 9 inning economic disruption that we're currently living in. Are we in inning two or are we in inning eight? So when you receive these unemployment numbers, and you perform some analysis on them, in particular this one, you see that the labor markets are softening for the white collar workers, right? Mostly tech. You were just sharing with me earlier today that, there's just been a plethora of tech layoffs over the past couple months. Okay. But we're not hearing a lot of, noise when it comes to our blue collar, colleagues, right? That are retail, plumbers, craftsman type careers. We're not hearing a lot of layoffs there. And really the reason is because we remain in an inflationary period, which means demand is high, right? So if demand's high, what are people doing? They're going to McDonald's, they're going to Walmart, they're going out to eat. They're spending money on new air conditioning units or whatever it may be. Maybe still spending a little bit of money on their houses. So why is that important in terms of timing? Because there's going to be a point when there are so many white collar workers that have been displaced that that's going to begin to affect demand, right? And we're going to start seeing demand pull back. And then what are we going to see? We're going to start seeing layoffs in the blue collar segment of our employee base. We're going to start seeing layoffs in retail. Why? Because people are going to move from using their income to buy what they need plus what they want, and they're going to start buying only what they need, right? So what's going to happen is those companies, even the Walmarts, half their store is what you need, the other half is everything you don't need, but you want, right? So that's why right now is such a pivotal point to look at the unemployment market and say, man, we're right at that teetering point, right? So right where that teeter totter is just perfect, 50-50 on that fulcrum. And now we're going to start seeing those white collar layoffs. They're going to start tilting. And when that begins, and demand's going to slow, because what's happening to these white collar workers, their salaries, wages are going from 150,000 a year down to, in California, I don't know, I think the unemployment maximum is what, 450, $475 a week. So they're going to go from making $10,000 a month down to making, $1,600 a month. The more white collar employees that are displaced, the more the snowball effect is going to take place. And then we will begin to start seeing layoffs in the blue collar sectors. So that's what you should be keying in on right now. That's the next shoe to drop to tell us that we are officially going into a recession. Okay. And depending on how quickly those blue collar displacements ratchet up will also be a great indicator to determine, or that allows us to determine how bad the recession will be. We'll start seeing more defaults, foreclosures, things like that. But right now, this last unemployment number, paired with the inflation data, tells us that inflation's hot, which means demand is hot, and it tells us that white collar workers are being laid off, but the blue collars are still working because people are still spending money in those areas. Once we start seeing layoffs in that blue collar sector, then we know that we've got a recession that's just looming, probably just a couple months away, because that means total demand is decreasing.
Hmm.
And then that's when we get that recessionary indicator, right? Which is negative GDP growth. But that's kind of where we are, man. That's why I think I'm so fascinated by what's going on just in the past week, we had the unemployment figure come out at the beginning of the month. We had retail sales come out, right? We had CPI come out. You and I talked about that in the last episode, that it ratcheted up slightly in the month of January from December. And then this last week, we got our purchasing price index or indicator data, which told us that wholesale prices, okay, the prices that manufacturers, okay, pay to produce their products that we buy. So this would be, whoever makes the plastic, whoever makes the rubber that one of the big toy companies uses. What is happening to those input prices for the products you and I buy? They saw the largest increase since the beginning of summer 2022 last year. And that's pretty significant. We're sitting here thinking that, we've been reading Fed's fighting inflation. They're doing a good job. They're slowing down interest rates because they feel that, inflationary pressures are subsiding. Well, it doesn't get much worse than the middle of last year when it comes to inflation raging. Mm. So we now are seeing that again, and it's causing some concern. We also received, and this is the primary reason why the market dipped the last couple of days last week and is already showing that it's going to dip tomorrow morning, is that we received, additional information that tells us that, the markets are in trouble. That we're going to be seeing a significant slowdown because wholesale prices, right, continue to rise, and they're rising at a really, really fast rate. So what does the Fed say? What are they doing? What did they come out with Thursday and Friday of last week? And the indicators are that this discussion that was had continues to permeate and reflect on the markets. It looks like tomorrow morning, Tuesday, is that we saw two Federal Reserve presidents, okay, from two of the districts that are out there. They came out and said that the last time they met, they supported a 0.5% increase, okay? And that took the market by surprise. And Mustafa, you and I had just started talking about this a few weeks ago, that I said it's probably going to rear its head, and we're probably going to see a higher rate, a larger increase in the rate. I'm sticking with my 10% is where we're going to end up with the prime rate. We're currently at 7.75. These two Fed presidents are saying that they voted for 0.5-point increases. So expect a 0.5-point increase here in the next couple of weeks. I think, when do they meet? I think the beginning of March. So expect to have a 0.5-point increase. So, and expect between now and then, what are the markets going to do? Continue to trade in that zone, in that range. Like I said, they're going to trade all year. We may get a little bit of more of a dip, but ultimately it's just going to sit there and ping pong, between a very, very small range over the course of the next year. But that's kind of what's going on in a nutshell. You got all these indicators that come out, and they really, really speak to anybody that's analyzing the economy. It tells them exactly where we are. Where are we? We're probably in about the fifth inning of this. Mm-hmm. I would say pretty early in the fifth inning, which means that's the midpoint, right? Start at first, end at ninth. That's the midpoint. So we're sitting right at the midpoint, and we got a long road ahead of us. But that's kind of what I wanted to discuss a little bit. And all those pieces, from the unemployment number to understanding where those job losses are occurring, to the retail sales number that was high, blew people away, now to the PPI, what wholesalers, or what's the wholesale price? They used to call it WPI, wholesale price index, which I think is just slightly different. But what are the manufacturers paying for the input cost to produce that product that you and I buy? And we're seeing that those prices continue to increase as well. To me, this is the complete opposite of what the markets have been betting on, have been indicating over the course of the last 3 months. And not only do we see it in one indicator, we see it in all the indicators. Every one of them is telling us that inflation is ever so present, and that it needs to be hammered. And that means we're going to see half point probably this month, maybe in a month and a half when they meet again, and potentially a third time. And that's going to get us pretty darn close to that 10%. So, and that's where I think we need to be.